On July 2, 1997, Thailand abandoned its currency peg to the US dollar. The baht fell 15% in a single day and would eventually lose 40% of its value. What happened next was not predicted by any major financial institution, economic model, or government, including the governments of the countries about to be devastated. For more than a decade, Southeast Asia had been the economic success story of the era. Thailand averaged 9% growth from 1985 to 1995. Malaysia, Indonesia, the Philippines, all posting similar numbers. Foreign capital poured in. $93 billion in private capital flows reached Asia in 1996 alone. The vulnerabilities were hidden beneath the growth figures. Banks were borrowing short-term in dollars and lending long-term in local currencies, a double mismatch of maturity and denomination. Property markets were overextended. Corporate debt-to-equity ratios were unsustainable. And all of it was held together by currency pegs that, once speculators identified them as unsustainable, could not be defended. The crisis spread with the speed of financial markets. Thailand to the Philippines. The Philippines to Malaysia. Malaysia to Indonesia. Indonesia to South Korea. Within 6 months, economies that had been models of development were negotiating emergency rescue packages. The Asian financial crisis exposed structural vulnerabilities that capital account liberalisation had concealed rather than resolved. The fundamental problem was a currency mismatch. Banks and corporations throughout the region had borrowed in dollars at low international interest rates and invested in local currency assets at higher returns. This was profitable while currency pegs held. When the pegs broke, dollar debts denominated in now-depreciated local currencies became immediately unserviceable. A 50% currency depreciation doubled the local currency cost of dollar debts overnight. The IMF's initial response, fiscal tightening, high interest rates, rapid bank closures, proved to be the wrong prescription for this type of crisis. Raising interest rates to defend currencies worsened the corporate debt burden. Closing banks created panic rather than restoring confidence. Cutting government spending in the middle of a demand collapse deepened recessions that the fund had not predicted. Malaysia took a different path. Prime Minister Mahathir imposed capital controls in September 1998, restricting the convertibility of the ringgit and preventing foreigners from repatriating capital for 12 months. The IMF condemned the decision. The markets punished Malaysia initially. But Malaysia avoided the deepest phase of recession that hit Thailand, Indonesia, and South Korea under IMF programs. The evidence was ambiguous, but the alternative had been demonstrated. On December 3, 1997, South Korea signed its letter of intent with the IMF. Usable foreign reserves stood at $7.3 billion against $60 billion in short-term foreign debt coming due within weeks. Without the $57 billion rescue package, the largest in IMF history to that point, the country faced sovereign default. The rescue bought time. What South Korea did with that time was exceptional. The government negotiated a maturity extension with foreign creditors, converting short-term debt to longer-term obligations. It recapitalized the banking system at a public cost of approximately 30% of GDP. It forced through structural reform of the chaebol conglomerates, the giant family-owned industrial groups whose debt-to-equity ratios had reached 500%. The Daewoo Corporation, one of the largest, was liquidated. $65 billion in debts written off. The turnaround was faster than anyone had predicted. South Korea returned to growth in 1999. Its current account deficit, which had been 8% of GDP at the crisis peak, swung to a surplus. The foreign reserves that had nearly run to zero reached $300 billion by 2010. The lesson was absorbed regionally, if not globally. Self-insurance through reserve accumulation was the only reliable protection against the volatility of open capital markets. The Asian financial crisis produced consequences that were simultaneously more damaging than most observers acknowledged and more instructive than most policymakers admitted. The damage was severe. Indonesia's economy contracted 13.6% in 1998. 24 million Indonesians were pushed into poverty. The suicide rate in South Korea rose 45% during the crisis years. Decades of poverty reduction were reversed in months. The political consequences were equally severe. Indonesia's President Suharto resigned in May 1998 after 32 years in power. The crisis delegitimized governments across the region. The democratic transitions that followed were genuine, but they came at enormous social cost. The institutional lessons, however, were learned. Asian central banks collectively accumulated $7 trillion in foreign reserves by 2010, self-insurance against ever needing an IMF program again. The Chiang Mai initiative created a $240 billion regional swap network. And in 2012, the IMF formally revised its institutional view on capital controls, acknowledging that selective restrictions could be a legitimate policy tool under specific conditions. The lesson that required 20 years to be officially acknowledged: capital flow liberalization is not uniformly beneficial. Speed of liberalization matters. Financial sector regulation must precede capital account opening. The Washington Consensus prescription had been applied without its preconditions. The Asian crisis played out on a faster timescale than the Japanese lost decade, episode 9, but its resolution required the same brutal adjustment, with the costs concentrated in countries that had less institutional capacity to absorb them. Speed was not the same as severity. The patterns repeat. The faces change. The cost is always borne by those who had no say. Economic Crisis Explained. 2026.